Hi friends, welcome back to the Finance Academy. Today, what if I told you a company famous for making IKEA furniture and toys is quietly becoming a global powerhouse in the fight against diabetes and obesity? Most investors still see Shaily Engineering Plastics as a plastic molder, but the Q3 fiscal year 2026 results just proved that Shaily is no longer just melting polymer, they are engineering a high margin medical empire. While the total plastic volume actually dropped by 12%, their revenue surged by 27%. How? They are kicking out low margin plastic chairs to make room for mission critical medical injectors. Today, we are breaking down the healthcare pivot, the massive UAE expansion, and why their ROCE just exploded by 1400 basis points. Let's dive into the research. Shaily is undergoing a structural metamorphosis. They are moving up the complexity curve into a medical device CDMO. Think about it. Once a global pharma giant like Eli Lilly or Novo Nordisk validates Shaily's precision lines for a regulated market, they can't just switch suppliers. The regulatory burden creates a massive competitive moat. Look at the revenue mix. Now the company generates nearly 42% of revenue from healthcare segment, 49% the legacy business from consumer, and 9% of the business generates from automotive and lighting, which is comes under industrial segment. So what layer? The magic is in the value add. Shaily is capturing more profit per machine hour than ever before. It's not about how much plastic they melt. It's about the engineering complexity packed into every gram. Why is healthcare exploding? Two words: GLP-1. These are the blockbuster diabetes and weight loss drugs taking the world by storm. Shaily is a dominant player here. In Canada, for the first 6 to 8 filers of semaglutide, Shaily holds a staggering 65 to 75% market share of the device supply. Now, the UAE masterstroke. Management just announced a 300 to 350 crore investment in Abu Dhabi. Why? Because of something called Operation Sindoor. Last year, Shaily lost a contract because a client feared having all manufacturing in one country. By doubting their capacity to 155 million units with a neutral location in the UAE, they have insured their future against geopolitical risks. Let's look at the quality of the earnings. The company's revenue grew by 27% in the quarter on Q3 FY26, which is an year-on-year growth, and EBITDA of 66.4 crore, which is a 43% year-on-year growth, and net profit 48% grew, reaching to 37.4 crores. But here is the kicker. There was a hidden bit. Shaily didn't even book their milestone-linked license fees from the UK and Abu Dhabi this quarter. If they had, EBITDA margins likely would have topped 29%. So if you see their efficiency gains, ROCE jumped from 24.4% to 38.4%. ROE also rose to 29.1%. And industrial mid-cap jumping 1400 basis points in ROCE in 9 months is almost unheard of. It proves that healthcare assets are vastly more productive than legacy plastic molding. And coming to its management and credibility, the execution depends on leadership. Shaily just hired Joe Cam as the new COO of healthcare. This guy managed 9 global sites for SHL Medical. Hiring a veteran of this caliber is a massive credibility moat. Management also promised to scale healthcare, commercialize GLP-1, and expand margins. As of Q3 FY26, the verdict is clear: delivered, delivered, delivered. Now, elephant in the room, the valuation. The company is now currently trading at a PE of around 64.6. Shaily looks expensive compared to commodity players like Finolex, but compare them to the high growth peers like Astral or Supreme. And remember, you aren't paying for a plastic company, you are paying for a medical tech partner. But it's not all sunshine. There are some red flags. First, execution risk. Can they navigate the new labor laws in the UAE? Second, consumer drag. The 13% decline in the consumer segment, IKEA, etc., is a drag on total growth. Third, customer concentration. They still rely heavily on few global pharma giants. So the next 12 months, we should track April or May 2026. Watch for high-speed pen line qualification. Second is healthcare mix. Does it crosses the 50% threshold? Third is semiconductor castings. Look for the first commercial supplies in fiscal year 2027. The JOCAM factor. Look for operational automation gains after March 1st. So Shaily is a rare story of a company successfully firing its low margin customers to become a global medical powerhouse. The earnings quality is improving as fast as the top line. If you like this video, please do like, share and subscribe to Murthy Finance Academy. Thank you.